So we all know that the pandemic has brought about major changes in office use in many large cities in the world. So to give you, some recent numbers, the turnstile data firm Castle calculates that, whereas office occupancy was 100% in January 2020 before the pandemic, that fell all the way down to 10% in the pandemic in the spring of 2020, and has only very gradually and very partially recovered to office occupancy around 40%. So what we do in our recent research piece, working from home and the office real estate apocalypse, is to ask, what does this reduction in use of office ultimately mean for the value of office buildings? And what we end up finding is that the pandemic and the practice of remote work has reduced office values by about 33% over the first year of the pandemic, and kind of longer run results in a value loss of about 28%. So if you apply that 28% reduction to the value of the entire US office stock, you end up with a $500 billion reduction in value. Now, that reduction in value is larger for lower quality offices, maybe as large as 44%, according to our estimates. And then the last kind of main finding is that there's substantial uncertainty around that number. We like to think of this as working from home risk. Depending on how the economy plays out, and in particular, depending on how persistent this remote work activity will turn out to be over the next 10 years, that number could be as low as a 45% overall decline, and as modest as a 10 to 15% decline. So commercial real estate data is traditionally very opaque compared to other financial markets like the equity market or the bond market, but increasingly there's been new data made available, and our paper leverages one source of data, namely commercial real estate leasing data. Right? So a lot of office tenants sign long-term leases, and we have excellent data on the terms of those leases. How long is the lease for? What is the rent that is being paid? And so forth. And so we use that data to basically explore and track the state of the real estate market as the economy goes through this COVID transition. Commercial real estate assets are a very large and important asset class, and they affect a range of constituents. One of them is city leaders, local governments. Another one is investors, and a third category is lenders. And I think these large-scale value reductions that we're talking about have major implications for all three of these food groups. So let's begin with thinking about investors. A lot of institutional investors, pension funds, have major asset allocations towards commercial real estate, and office is often the largest component of that. So if you imagine that typical office that is being invested in is funded by about a third of equity and 2/3 of debt, then a value reduction of a third basically means that equity investors are losing nearly their entire investment, at least on average. And so this is obviously a big deal if you're a large investor in office, such as a pension fund. If you're a lender, again, a lot of buildings get bought with debt with substantial leverage, 2/3 on average. Depending on, how large that loss is, you may be facing a loss as a lender as well. So a lot of building use will need to be readapted to the new mix of people that's in the city and the new uses, and the new functions that we use our real estate for. A lot of the natural conversion is towards residential, right? Given the scarcity of housing that we have and the affordability problem we have in a lot of our large urban centers. One issue is that a lot of office product is not easily convertible into residential real estate. So for sure there will be conversion. It's going to take time. Sometimes the only conversion will happen through demolition, which means that somebody needs to take a large loss on an office building before that conversion can take place.